Hey, if you're looking to learn how to get money, where to get it, why you should get it or why you shouldn't get it, or you just need some advice from a guy who's practiced in both the macro and microeconomic climates, maybe even get help or advice from this gentleman on how maybe he could invest in your business, then you're going to want to listen in today. Okay, he and his partner, they've advised or worked with Fortune 50 companies actually, and brands like CrossFit, Procter & Gamble, LabCorp, Techstars, and that's just to name a few. He was a competitive tennis player in college playing for Penn State, turned hedge fund investor trading commodities. Then he turned into a competitive CrossFitter because he's an athlete, so he had to get into more athletic stuff, and owned a CrossFit gym, then competed at the 2015 CrossFit Games, and now he's the co-founder of Sage House alongside his other co-founder, Jason Crowell. Today, I have the guy with the answers, Jim Crowell. Jim, I love the Sage House name. Was that name purposeful? Sage being the herb to generate wisdom and clarity.
Yeah, it was at the end of the day. We, one of our co-founders was Jenna Randolph, and we were just walking through a big branding exercise, and I just kept kind of coming back to, we want to be the place where people feel like they can go for connectivity and answers. Yes, not answers for me specifically, but just sort of answers within a collective environment. And so the house concept was certainly early on in the conversation. And then Sage really represents potentially, right, intelligence and mastery, which we love the word mastery, but it also represents, to your point, like an organic, herby type of feeling, which is, what we're trying to kind of send into the world. So definitely it was purposeful, and we like it too. So I appreciate it.
Yeah, I love it. Getting rid of the negative energy and inducing positive energy into a house of knowledge. It's awesome.
Yeah.
So, I have quite a few questions for you, because I think the listeners who are in that position where they're looking for money, they're trying to figure out how to grow their business. They're sitting in a position where they're, back and forth, they're collecting only enough money to get by. And so they play the role of the coach. They're on the floor being the trainer. They're trying to run the gym. And a lot of times they think they need more money. And sometimes that's not the case. And sometimes it is. And then you have the group of people who are in the position of actually buying gyms today, right? Because a lot of them have closed down, or they're kind of hitting their stopping point because whoever's there, they just can't, they don't have the willpower or the expertise to continue pushing it forward. So somebody comes in and buys it, and the climate may not be the right time to buy gyms or to even start gyms. To get money is expensive today. And if you're in a position of renting space, commercial spaces are not inexpensive today. They've continued to climb. So is it the right climate to be opening a gym or buying gyms from somebody who's, are you catching a falling knife? Is that what's happening?
Well, let me preface anything that I say with, we are actively working on building a franchise brick and mortar gym concept as we speak. This is notwithstanding the difficulties that you just mentioned. So we're very aware of those headwinds, but I am a believer that the best ideas and the best environments typically win out. And if you have a really, really strong idea and you've got the willingness and resilience to execute on that idea, I'm sort of the mindset that it can work if you have the runway to do it. Now, obviously, if you have a 2008 situation and you got over levered, and there's always outlier events that could potentially happen. But I think if you have a great gym model, you can push on it. You just need to be smart about how you push on it. And what I typically see is there's a huge difference between let's call it mom and pop, not to be demeaning, but just to be a size constraint, versus a corporate and or franchise concept. And people need to know that that's very, very different. And so you need to treat them as such. But if somebody wants to grow something from single gym to multiple gyms, there's no way that you can do it either without a lot of time or without money earlier, because the gym is not going to produce likely enough income for you to just keep putting new gyms down because of the capital expenditure with which you have to do it. So you do definitely need to think about that runway of cash and how you're going to build it.
So in that scenario, I mean, you mentioned that you guys are, just out of curiosity, what's the style of gym you guys are on the verge of, or in the process of expanding with?
Yeah, we're going health span. So,
Okay.
longevity health span. Within that, it's group training. It's around 35 to 55 age range demographic. We will have a Leico gear, so top-notch gear is going to be in the facility, and it'll basically be a two area layout: strength on one area, aerobic on the other area. And a 60-minute class would see you go to two areas, but we're rolling 30-minute classes because our demographic needs them. And it's a really good way for us to have specificity within classes. The really interesting part, though, that we're building, and here's where we're, investing a chunk of money into, is we're making it tech simplified and we're creating the first ever group-based assessment.
Hmm.
So we're going to have technology that's actually going to assess people very particularly, both in gym and then outside of the gym. We'll aggregate that data and we'll be able to customize a program. I don't mean personalized, like we want it to be group training. That's a big important part for us from a community standpoint, but we do want it to be better training. And so we're going to have that assessment that will give us a custom member app, coach app, and then we'll actually have iPads on the racks as well.
Cool.
And people will really be able to kind of see how they're doing. And then we will deliver them a health score. And so our gamification is long-term health score.
Awesome.
So it's, we think the future will lie in longevity, health span, et cetera, particularly around strength.
So, you come from a CrossFit, well, I shouldn't say you come from a CrossFit background, but you had laid some foundation there,
Yep.
some years ago, and you work with OPEX. You were the CEO for OPEX for several years, and that's a CrossFitter style of coaching. So, looking back on that, and now you're evolving into a different space. It sounds like kind of group and more personalized, and demographics probably match actually, or very close to the CrossFit demos. But I look at that and I go, okay, CrossFit, the space requirements that you need is more warehouse style space, right? High ceilings, low rents. And now you're talking about a space that, in the picture I'm painting in my mind, I could be way off, is more retail center space,
Yep.
where rent is going to be high. So how do you get into a position where you protect your downside in the event of a climate downfall, and you still can preserve what you need, so you don't have this rent that's just going to eat you up?
Yeah. Um, I could do hours on this particular question. So I want to preface by saying I'm giving an extremely truncated answer to this. I spent 4 months building our financial model. So that's
Mm.
the starting point. I needed to know what this model, in theory, right, could produce. And based on what it can produce, that to me allows me to better understand what the commensurate risk is in it. So if, for example, I can produce, I'm just picking some round numbers,
Sure.
okay? If I can produce $1 million a year in revenue and 30% EBITDA margins and make 300K in operating income, ish, then if my rent is 10% of that $1 million in revenue, or just call it $100,000,
Mm-hmm.
I'm in business. And that to me is commensurately low risk. If I have 25% in expected rent versus revenue, I have a problem, in my opinion. I've got too much rent expectation. Now, if I can't fill the gym, I could have a problem even if I believe I can get to 10% rent versus revenue, where the money starts to come in, like the investment starts to come in. We're working very closely with sales and marketing experts to build out our pre-sale and launch plans. We're working very closely with branding people to make sure we've got a brand that day one is something that people will really resonate with. We're working very closely with franchise development teams so that we have the right structure and operational, call it constraints around
Mm-hmm.
it. We're working with a real estate team to make sure that we're in the right area with the right demographics so that when we launch, we have a better probability of success. So to me, risk is commensurate to probability of complete demise as well as what is the potential for asymmetric upside. So I feel very comfortable, even if we're paying, pick a number, $10,000 a month in base rent. Keep in mind, our facilities are probably going to be around 2,800 square feet, so not 5,000 square feet like a CrossFit. We have an extremely efficient layout for what we're going to offer in class types. And that's one of the reasons we went with Eleiko, is because they have the best and most efficient layout if you want strength. You pay a little bit more for it, but Eleiko stuff never goes bad.
Great product.
Right?
Yeah, no,
right.
It's a
So,
really great product.
you know, so everything kind of has these trade-offs. And so if your big question that I'm truncating is, how do you look at higher rent versus the risk of losing it all? I would argue that it's the exact same as if you paid lower rent but had lower revenue potential, all things equal, right? If you don't have the commensurate capital to open either one of them, it's the same risk profile, right? And so I think that people just need to realize there are different games that can be played and different cost structures to those games. You need to make sure that whatever game you're playing, you have the financial mathematics on your side.
Would you say 10% is a good rough number to use for those out there looking at rents today? 10% of your total predicted revenue?
Yeah, I'm not nearly as intricately involved in large health clubs like Lifetime, Equinox, etc. So I'm not going to speak to that at all.
Sure.
Boutique franchise, 10 to 15% is the window.
Awesome. I think that'll help a lot of people who are listening to this.
Yeah, so, if you're at 25%, that's not good.
Yeah, you'll be bottoms up pretty quick.
Sorry, let me be more clear and helpful. If you're at 25% when you have optimized revenue, that's not good.
Yeah. Okay. Yeah. That's, for anyone listening, what he means by that clearly is once you get to a point where you've kind of stabilized your business, if you're at 25%, no bueno. So, you know, get those numbers figured out, and you should probably be there. What would you say, within 12 to 18 months, no longer than that?
Yeah, I think that's actually a really good time frame. We are trying to come out of the gates with a pre-sale that will allow us to be profitable the day we open. Now, awesome. That's not normal. So I'm not underappreciating the difficulty that will take. We're talking like we need 750 or 800 leads type of thing. And for a lot of mom and pop gym owners, it's like, what? Right? So we're approaching this with the mindset of the goals to be break even day one. Whatever it takes to get break even is what we're going to do. That is not the same. Yeah.
And if you can do that, and you can support your franchisees with that same model, forget it. I mean, everybody's going to be franchising this model and this brand.
Yeah, if that's, I mean, obviously that's a big assumption on our part, right? So I don't want to say that is proven out yet, but that is a huge place that we're putting a serious amount of effort into. And, you know, if the conversation that we're kind of underlying this with is investment and capital, et cetera, we're paying a lot of money to put this together up front because we think it's that important.
Yeah, well, I mean, as long as you start out of the gate strong, and you can maintain your customer base so they don't leave as soon as you start, then you're in a really great position.
Yeah. So, I mean, and for us too, sorry, one more point on this. We're also different from many people who might be listening to this, where we are building facility number one to mirror a franchise. This is not like we'll put one down on the ground and then maybe 10 years later we'll have kind of figured out the concept. Facility number one will equal a franchise and will scale from there. Again, the goal, we haven't proven it yet, but that's how we're coming out of the gates.
I think if you have the right marketing strategy and the tactics to go along with it, I think it's pretty easy to win in that world, especially if you have a strong marketing team that can help, really put that together and initiate it.
I hope
Obviously,
so.
You got to have a sales team there too, right?
Yeah. Without a doubt. Yeah, I mean, it's a It's a lot of execution around those points, in my opinion. It's not rocket science. It's just execute like crazy.
Right. So, if you're these mom and pop gyms or even a franchise, right? Obviously, if you guys have a franchisee come in and they want to buy into your concept, I'm sure you have the opportunities for them to go out and get the financing they need, or maybe even there's assistance from your own group. But if you're a mom and pop, to your point, or a boutique, because that's where that's like a large percentage of the gyms. If you go out to get money, what's the best way to get it? How would you advise them in today's climate?
Hmm. Well, forgive me if this is a little bit of a teacher style way of looking at this. I used to do
Mhm.
all the business education at OPEC, so I kind of still talk like that. But um, to me, you have to look at what are potential options, right? And so if you're up and running already, you kind of have three options. You can either reinvest any profits that you make, if there are any. You can go get equity capital, i.e., you bring investors in who give you money for percentage of your company, or you can take debt capital, loans. Those loans could have a lot of different types to them: credit card debt, lines of credit, equipment loans, capex loans, working capital loan. Like, there's lots of different ways of doing it, but ultimately it boils down to self-funding, equity funding, or debt funding. And so it's going to be one of those three. And what I typically find most small business owners, and I'm talking like up to five, maybe even $10 million a year, what they typically perceive the pathway is, well, I'm just gonna reinvest the money that I make.
Mhm.
And there's no problem with that, right? Like, that's an amazing way of doing it. It saves you equity, it saves you, any potential leverage, which is risk, really, at the end of the day. The issue that I typically find is that they do it far too small. And so they might make $10,000 in the year, and they might reinvest $4,000, and it's like,
Right.
so what? I mean, like, that's just not at all enough to build a business today. And so I try to kind of get people to view this idea around um, what is appropriate for the growth rate that you intend to achieve. So instead of just bringing in money and hoping that you grow, what are you trying to achieve with this money, and what is actually required? That's a bit analytical at the end of the
Mhm.
day. But for a local gym owner who wants to, say, go from, I'm picking random numbers, $100,000 in revenue to $300,000 in revenue, it's highly unlikely that you can do that without having a larger cost structure to support it. So would you rather, inch your way up and try to be like, okay, we made $2,000 here, so I'm going to reinvest 1,000, and
Right.
12 years later, right, you've gotten to $300,000? Or would you rather invest your way, again, with any of the three options, right? Would you rather invest your way to compound that growth faster? That is a pure business decision. I'm not going to sit here and tell somebody what's right or wrong, because there's a lot of folks that cannot stomach either partners or debt risk. And so I would not tell them to go into those structures, but I would try to tell them the truth, to say it's probably going to take you a while to scale this thing up. There are certainly some local gyms that scale up really effectively, but what they typically do is they work harder, push harder, do more things than the other groups that aren't
Right.
reinvesting the capital. So it's a similar concept. Um, but if you want to compound revenue and profit, you have to put initiatives into place that theoretically will accomplish that. Typically, those require resources. So it's like, hey, I don't know how to market. Either you have to learn, or you have to hire somebody that's really good that can help you. And what I typically find most small gym owners doing is somewhere gray in the middle of one and two, and getting really
Mhm.
bad talent to help them.
Right.
And
Yeah,
so I'm not
I
saying,
agree with that.
yeah, and so I'm not saying that you need to spend top dollar, but you need to have a very clear understanding of what the milestone goals are that you need to achieve, and you need to put resources on those to achieve those goals. And that's it's rarely $0 in investment. And so I would kind of harken back to, if you have serious growth goals, you need to put resources towards them. If you are the best resource to get to my sound back, sorry about that.
There we
If
go. Yeah.
Yeah, if I lose, or excuse me, if I'm the best resource to accomplish the goal, then that's still an opportunity cost, right? And so the opportunity cost is, I could be doing something else that might help me compound more effectively and aggressively. And so this is just a chess game of how you manage your resources, and there is always money involved, always. What is the best way to bring in capital? The definition would be, what is the lowest cost way of bringing it in, and usually that comes down to what is called the weighted average cost of capital, right? And so basically, if you can bring on debt, I'm just going to super low number, if you could do a 30-year loan for your gym, this is not going to happen, by the way, but if you could do a 30-year loan for your gym at 1% annual interest, the cost, essentially without fees, right? The cost is 1%. And let's say you wanted to borrow $100,000, you're paying $1,000 a year. So great. My cost is 1% on that money. If you were to go sell 10% of your company for that $100,000 investment, you're basically selling, 10% of, you're implying a $1 million valuation at that point. And
Mm-hmm.
so if you believe that your business can grow to $100 million, again, a big number, then that 10% is now worth $10 million, right? And so you have given away a significant amount of money on that exit, and there is a commensurate value that would be attached to it. Just so that I'm clear, whenever I look at the cost of equity, I look at it from basically a risk standpoint. So, how much risk would I, as an investor, be willing to take for this investment to get to a certain valuation? And that is rarely below 15%.
Mm-hmm.
And so, what I'm saying here is that the equity cost is about 15%. And so, if you are the person who needs cash, again, this is massively truncated, so forgive me, but the equity cost is around 15%. If I can get debt for 1%, that's a 14% difference. In that
Right.
situation, all things equal, it's much less expensive to get the debt. However, I have to be very careful, because if I don't pay back the debt, I go bankrupt, right? So there is always that opposing side of leverage, i.e. debt, is that you go bankrupt if you don't pay it back. If I don't pay back an investor, that sucks for the investor, but I don't go bankrupt. So,
Yeah.
there's a cost, and then there is sort of the ultimate downside cost, which is bankruptcy. And those are the two differences. And so every single person is going to have a different risk tolerance. They're going to have different circumstances that lead them to different types of structures. They're going to have different credit levels, so they might not be able to get a loan. If they haven't been in business for 3 years, good luck getting any kind of normal, 2 years, I think, maybe. Good luck getting anything outside of a small business association, SBA loan. And so you have to go search your options. And I know that that's not the cleanest, like, do it this way, but that's the reality of what a gym owner is going to face. And so I'd rather answer it that way.
No, I think that's pretty clear, actually, because you look at some of, to the question I was asking earlier, and how most of these business owners, a lot of them are small business owners, and they're either buying somebody else's business, or they're coming in and trying to start up. And no different than the day when you went in and started your own CrossFit location. You're doing a lot of things, right? A lot of things on your own, and you're trying to figure things out, and build your organic name, get people to know who you are. But these business owners, they come in, they haven't been around for 2 years. They're brand new. And a lot of times maybe they don't have the credit worthiness to go ahead and get the loans that they need. So there's challenges, and they need a runway,
Yep.
right? They need both the runway and the resources to get done what needs to get done. Otherwise they won't grow. And sometimes that's just, it's either raw talent, and they execute well, or it's them just grinding it out and building.
Yep.
So if they don't have the capital to pull out of their savings account or their bank, and they're going to bet on themselves, there's a strong chance that they may not make it. And I think a lot of them go into this where because they don't teach this. I have an exercise physiology degree. And I always tell myself, man, I wish I would have got my master's degree in business and finance, because it would have saved me a lot of headaches. But I went through the process and I learned the hard way. And I think that a lot of business owners that get into this, where they own gyms, they have the knowledge of the body, and they understand how to go through and train people, and they do a great job of those things, but they don't understand or fully comprehend the nuances of business and the way to get money, or the way that you have to grow your business. And there's no strategy or structure or system in place to really make that happen. And that's why franchises exist.
Yeah, I very much agree with what you just said. Typically, what I see in these types of businesses is that they can be solid owner-operator businesses. And all I mean is that as the owner, you are kind of like the main operator doing the day-by-day work. Franchisees, in theory, this is how it should work, should be efficient enough and effective enough where the owner doesn't have to also be the operator inside of the space. Now, maybe they spend a lot of time up front to get a facility open, but then they have a GM or studio manager or whatever, and the coaches, and that system is run by that person who's running the day-to-day. The reason why that's so relevant to our conversation is because the owner-operator model, assuming that you're not making absurdly high profits in it, which virtually none of these folks are, unfortunately, is not an asset value, because the moment that you count how much you pay yourself as a cost to the business, most times those gyms' profits go to zero.
Right.
And so the asset value of that gym is very low. You might be able to sell it for the cost of the, like the value of the equipment or whatever. The unfortunate part is that most small gym owners believe they have asset value that has saleable value behind it. If you are, I'm not hammering on CrossFit. I love CrossFit, but there are lots of CrossFit gyms who over the past 6-7 years have tried to sell and have found no buyers.
Mm-hmm.
Now, others have, right? But usually the ones that have either have a big network of folks who kind of just want to be an owner operator or just love the CrossFit gym or whatever, or they have significantly higher profit than what it costs for them to operate, and somebody else can own it, so they'll pay a premium to what the equipment costs. But many cases I have seen where I would actually put a negative value on the business because the value of the equipment is less than the liability of the lease that's left.
Right.
And so I don't necessarily want to come in to buy an unknown brand, right? Because if you are a CrossFit, you're part of the CrossFit brand, but you're very different than all the other ones, and it's just kind of confusing. So I'm not going to give you, the gym owner, the premium on that per se, right? I might have a little premium because CrossFit has a name and I like the brand, and there is some value to that. But if the business isn't profitable, you don't have an asset. And what does that then factor into? What do you get out of the business when you leave? Well, let's just say that you paid $250,000 to buy all your equipment, to do the capital expenditure. And by the way, that's not a bunch. Most franchises are far more expensive than that to open. But if it costs you $250K and then 5 years later you sell it for $50K for the value, it's like, okay, are you counting the $200,000 loss that you took on that equipment? That's not good. Right? So you have to think about like the totality of these investments.
Yeah. And I think getting into it, kind of circling back, you have someone who's super ecstatic about being in the fitness industry. They love what they do. Their passion, becomes their business, and they're in it every day, all day. And what you end up seeing is, to your point, they are the business. And so they're investing all this time, all this energy. A lot of times the money that they are earning is not going somewhere else in investments, right, to continue to grow that money. They're taking that money and living off of it. And so when the day comes to sell, they have no multiplier on it.
Yep.
Right. Sometimes that multiplier could technically be a negative multiplier, because there was no plan or strategy to go, okay, I'm going into business now. And because I'm going into business, I have to plan this thing out. Where is my exit? And a lot of times there is no exit plan. A lot of them don't even put together an operating agreement. Some of them don't even put together, a whole financial model on how they're going to grow their business and what their business plan is. They just
Yep.
open it up.
Yep.
So I think it's really dangerous in those scenarios. And are you suggesting or implying that your guys' franchise fee is going to be, to open is going to be about $250? Not the fee, just to open.
Oh no, we'll be more expensive than that.
Okay.
Yeah, no. Well, let me not say an amount because I don't want to have any
Sure.
FDD
Yeah,
doc,
backlash.
whatever. Yeah.
Yeah.
But no, it will. So let me break it into two parts. We believe that the total cost will be higher than 250K, but we're also setting up loan structures for people who want to do CapEx and equipment loans. So the cash outlay, we hope, could be less. And again, I'm trying to be a little bit gray to not,
No, I
get
understand.
myself
Yeah.
in trouble,
Yeah.
but we are certainly trying to keep the cash day one that somebody has to invest to be lower without increasing the risk beyond what is palatable.
Yeah, I love that. Are you releasing the name of the brand that you guys are going to be speaking on?
Oh man, yeah, sure. I will tell you, our website actually hasn't even launched yet, so give us about 2 more weeks and that will launch. This has been very under wraps for a while though, so we're calling these Proof 3.
Awesome.
And so it's all about us proving out that we can get long-term health span results.
I love it. So you guys heard it here first, launching
You
Proof
did.
3. And yeah. So even before the website is live.
That's right.
So speaking, you kind of, I'm going to go off of Proof 3 because it reminds me of an NFT. So, looking at the future here for a second, you've got cryptocurrency, right? It's turning a corner. It's increasing its value in certain markets, and you have ETFs, okay, soon to become available for Bitcoin. Legislation is going through that process, and you have the SEC that's going through its approvals, and then you have the G20 summit pushing for Bitcoin. Okay, you've got the next G20 summit in Brazil, and I've got my own perspective and speculations on where things are headed. And I've been saying the same thing for years, and I think Bitcoin's going to, really crush it over the next 5 years, and you're going to see a huge rise in it. But I want to hear what you have to say, because you come from this like hedge fund, macro and microeconomic climate. You understood, you traded, several different commodities, and you were doing it in 2008. And you move into CrossFit, which is just like no tech whatsoever. And it's, it's chalk and, working hard and sweating hard.
I loved it, by the way.
CrossFit's awesome.
Loved it.
And then you move into a space where now you've been advising big companies. You've been advising and assisting in the investment side for other brands, and now you're in the almost kind of driver's seat, or at least in the same car, with groups that are going to be opening this, Proof 3 big franchise that I'm sure we'll see do really well, and it's tech enabled. I mean, it's highly tech enabled. So you look at this, and you guys even invest in tech companies. So I'm looking at it, I'm going, is Jim focused on what's happening with cryptocurrency and NFTs and blockchain tech and Web3? If he's focused on where's your head at in this? What do you think is going to happen?
Let me say that I don't at all consider myself a cryptocurrency expert. So that's important for anybody listening to know. I have a working knowledge of how it functions, of where it came from. I'm a big believer that the blockchain is interesting, although a massive energy suck, right? So it's an interesting sort of juxtaposition between the two. But I get why the technology of the blockchain is really important. And I'm a big believer in just kind of infrastructure concepts. The way that I think about Bitcoin is to ask one question. Is it a currency or is it a commodity?
Hmm.
And I think depending on people's perception, the value of it would be significantly different. And so I'm looking at something like Bitcoin, asking myself if or how gyms or our companies, or our consulting clients, how they will use it, right? If people want to use Bitcoin as a means of exchange, it's a currency. And I think that over time, there will be more regulations, there will be more banking connection, and so it will function more like a currency. Because there is theoretically, right, a limit to how many Bitcoins there could be, though,
Hmm.
you now have a demand constraint in the system, which could lead to Bitcoin being much more valuable. Now, I'm not suggesting that I believe it's going to be a bunch more valuable or not. I'm not in it day to day enough to have that kind of an opinion. Um, what I think is interesting, and what was the book? It was a book of, was it by Schiller? Some kind of economics book. If I think about it, I'll mention it. But there was a really good book that kind of talks about different origin stories of
Hmm.
um, a number of things, but cryptocurrency was one of them. And there were a lot of confounding events that led to why crypto, particularly Bitcoin, went bananas X number of years ago. And I think that if we say that this is thought of as a currency but has commodity like demand components, you have to then say what will move the price of it.
Hmm.
And ultimately, at the end of the day, it's do people have a demand to hold it? And
So
that, yeah, go ahead.
would you relegate it in the same light as synonymous with gold, in the sense that gold can be both?
I would say, uh, actually, I think that I would to a degree. I think I would to a degree because people view it similarly. And there is, again, in theory, there is a fixed quantity of it. What gets really interesting, though, is
Hmm.
what do you peg gold to or not, right? So
Right.
gold wasn't nearly as valuable until it was depegged from the US dollar back in I think it was the late 60s, early 70s. And so I would assume that more regulations are coming for Bitcoin as opposed to fewer, which to me would probably make it less volatile than it has been for a while, which always infuriates the traders, right? So traders want volatility. Um, I am definitely a believer, though, that people want means of exchange. I do think that the concept of having crypto makes a lot of sense because it's a different way that people can exchange goods, services, in theory, a responsible and trackable way. That makes sense to me. So I think that there's a reason for it, but I can't sit here and say I think Bitcoin's going to 100,000 or whatever. I don't know.
Yeah, I don't know either, but I'm going to say it anyway.
Yeah, yeah, but I don't think it's going anywhere. I do think though it's too easy to create what is considered cryptocurrency,
Oh, I
right?
totally agree with you
And,
that.
and
Yeah.
so, that's why I believe there will, whether I believe there should be or not, I believe there will be regulations because if you want global demand, you need globally uninformed people to feel confident
Yeah.
enough to own Bitcoin. And so, you know, whatever Dogecoin, all that stuff that just gets propped up by celebs and whatever, it's like that's
Hmm.
just, to me, that's harmful to the longevity of something like Bitcoin. And so I think regulations are coming, which has obviously all kinds of downstream effects to it.
Yeah, and I think that's where you look at gold, for example, was traded as a currency eons ago, and now it's been pegged and unpegged, and then you get into a position where you look at Bitcoin, and to your point, a crypto token, something that's cryptocurrency, can be created by essentially anyone, and the value is only uh, what the people believe the value to be.
Right.
It's all perception
Exactly.
anyway at the end of the day.
Exactly.
So
And I mean, I don't know about you, but I've seen a lot of, what would you even call them? like fake crypto tokens, right? So
Oh
it's like,
yeah,
hey,
yeah.
we'll exchange this absolute utter nonsense, and we'll then try to do a tokenization. It's not even the right term, but it's not actually crypto. And so what's happening is I think we're getting in more and more of these like micro communities, right? And people are trying to sell to the micro communities. So you're seeing all of this nonsense come about that has
Mhm.
no value whatsoever. But to your point, if you can get a large enough audience to be like, I want that, then there is some amount of value to it for some period of time. It's just that if you don't connect it to the global infrastructure, it can't actually function like a normal currency. That's to me the issue, and that's why I'm just assuming that a lot more regulations coming. And the second that that gets announced, then all of a sudden all the banks will be on board, and blah 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 blah, and then it'll be a currency. And I would assume that it would be Bitcoin, or maybe just call it
Or
Ethereum,
Ethereum.
right? Like,
Yeah.
yeah, I mean, but um, I don't see how we don't end up in that environment, because what do even traders, right? Like, what do traders want? A lot more demand.
Mhm.
People who think it's worth something want a lot more demand. Well, how do you get it? You open it up to people who don't understand it.
Right. And they can transact on it using an ETF.
Exactly.
So circle back onto this topic too. I know we went kind of down the rabbit hole on cryptocurrency, but uh, I want to see if you can just give some advice to some people that I've talked to in the past, and they'll call me up. They use my software, so and they know that I have a history in fitness and in ownership of facilities. So when I'm having conversation with them, a lot of times they try and wrap their head on what they need to do, and they just get so torn up over all of the hats, all of the things that they need to do in a day, and they just don't have the time or the money or the resources, right? So I have a few people, both of them are in very similar situations. They have a PT studio, and the demographics make total sense. Uh, the rents are good for them, but they don't have the traffic that they previously had. Both of them are studios that were purchased from another owner, and they're losing money every month. And now the owner of the facility has to go back to spend time either in coaching, or they're in a boat where they're going, well, it was working and now it's not working. How do you advise on that? Because I mean, you are an advisor, and that's a big component of the Sage House, and of course, you guys do this on a bigger scale. But when you look at these mom and pops, and they're trying to run their own show, and they're trying to figure it out, how do you advise those groups? Because I guarantee they're going to be listening to this,
Yeah.
and they're going to go, "Oh, that's good point."
Yeah. The honest answer for me is that I don't have a template, but the principles are always the same. I need to
Mm-hmm.
understand what's not working. And so, did something actually change in the business, or did the economic environment change, or did somehow demographics shift? Not likely in this
Right.
fast of a time period, but I ask enough questions and ask for enough tangible information to surmise what I believe is going on, and then we start to attack that. So if your product is outstanding, and I'm just going to be bluntly a prick here and say most local studios product is not outstanding, but if it really is outstanding, then we don't focus on that primarily. We let that system run because it's working really, really, really well. And you would see that in higher than average retention rates, right?
Right.
And higher than average willingness to pay. There's a little bit of a salesmanship to the willingness to pay, but people will pay you more if they love the product. So if that's really, really good, and again, I'm truncating this too, then I would start to move out to, well, why aren't you getting more people into the facility? And there might be some simple things that they can do, like, are you asking everybody for a referral every time they buy? No? Okay, well, let's do that. And let's structure how you're going to do that. And let's make sure that there are referral campaigns. And let's make sure that you have surveys that lead to referral campaigns. And right? Like, you start to,
These are things that you've actually done
oh, yeah.
actually in your CrossFit gym, which you exited for and at a premium. So continue. Sorry, I
Yeah.
just wanted to let the listeners know that it's not like you're coming from a position of financial advisor slash investor slash the guy who understands economics. It's a guy who's giving you guys advice on this that
Yeah.
really does understand it because he's been in the grind.
Yeah, and I've owned group training facilities. We've
Yeah.
done boot camps, and then OPEX was all individual design. So it was
Mm-hmm.
much closer to a personal training facility than what a CrossFit would be. So I've definitely lived through much of this. Um, Kind of going back to actioning on this, just to be fair, many local gym owners spend too much time doing unimportant things. And so if you aren't bringing in enough new people, but you're spending 70 hours a week coaching people on the floor, either you have to remove some clients, which everybody always says they don't want to do because that harms their revenue. Fair,
Right.
but welcome to the spin cycle of death, right? Or you have to bring somebody or somebody's in to help you set up the piece that isn't there. Now, me just saying that, all I can think about in my head is if you as an owner operator can't support the business with your core product, there's probably a product problem too, right? So I don't just want to say it's always sales and marketing. It's often not always sales and marketing, even though typically local gym owners are not good at sales and marketing.
Mm-hmm.
Some of them are quite good at consultative selling when somebody gets in front of them because they just build great relationships and they can
Right.
sell. That's great. However, there's not a system of taking somebody who doesn't know you, making them know you, getting them interested in the gym, making them realize that your gym is better than their other options, and then selling them when they're like, oh man, I wasn't even thinking about buying that.
Right.
Right. And so you have to build that system that is duplicatable. So again, to your point on franchising, what we are attempting to build is a system that I can drop into any building, teach them how to run it, and their GM and their coaches and anybody else who's in that space can run the program. And obviously, the software can deliver on that program too. Um, but you have to understand what isn't working. And most gym owners either don't think about that or don't necessarily have the perspective on the reality of that. But for example, PT studios, um, oftentimes what I see in PT studios, they don't have good enough gross margin to ever grow effectively enough.
Mm-hmm.
And
Yeah,
it's
they
like, well,
undersell.
I want to pay my coaches well. It's like, great, but do you want to have a business too? And
Right.
it's like, there is always this trade-off of I want to pay my people more, but I also want to grow the business. And you have to find an equal, uh, both fair to you and fair to them. And no, I'm not suggesting underpaying your people. I actually prefer to overpay our people, but it's within a business model that can overpay the people.
Yeah. A lot of times I see, especially in PT studios, they, and a lot of times because they haven't been formally educated in business, it's usually just through learned experiences, but they have a hard time raising prices, right?
Yeah,
So
big time.
they go, I really like Jim. Jim's a nice guy, and I don't want to charge him more than $30 an hour for sessions. And I'm going, wow, your rent is never going to get paid, or you're going to need a lot more people in here, which you can't support because the space is too small.
Yep.
So there's the reality that a lot of times price has to increase, and just simply by increasing price, you can pay your people more.
Assuming
Right.
people stay, right?
Right. Yeah. Yeah.
I
As
mean,
long as the product's good enough.
yeah, exactly. I mean, you can tell that I'm an it depends guy for sure. There's always nuance to this. I agree with your general statement. It's just I've seen gyms raise prices and get hammered
Oh yeah.
because they don't have relationships with those folks. So, to your point on, I'm not saying these two people have this problem, but if they did buy facilities from other people, if the vibe of the facility is not what it once was, and they go in and immediately raise prices, they might actually harm
Oh
that
yeah.
relationship even further. Um, I mean, what I tell basically every gym owner that asks me is I go, just write into your initial agreement that every year prices will go up 5%.
Mm-hmm.
And if you
Right.
only raise them 3%, then you've just done them a service, right? It's about the
Right.
expectation that you set. The problem with gym owners at the local level is they set an expectation like, oh, we'll never raise your prices. And then
Forever.
when,
Right.
it's just, it's unfortunate. I mean, and I've been in that bucket too, right? Like I'm not saying it's easy to do, but if you have a good relationship with your people and you're underpricing, you can raise prices. And I've seen people have 100%, conversion into the new prices. Not everybody, but like as long as you're not hammering people on price, like they want you to succeed because they like being in your gym.
Right. Yeah, they don't want you to leave.
Right.
Jim, I got to tell you, you've covered a lot today, and I can't tell you how appreciative I am of it, because I think a lot of listeners who are listening to the advice that you're giving, they can take away actionable steps. And if you were to surmise some of the things we talked about today, what are the top 3 things you would recommend for fitness owners outside of going and getting a Proof 3 franchise?
I think knowing the game that you're playing and creating a duplicatable playing field or playing board is really important. And so whether that's getting capital or whether that's raising prices, you need to know why you're doing it and where you're going because of it, and then you can action on it if it's a priority. And I would encourage gym owners to really remove things that actually aren't priorities, because they do a lot of things that really aren't very valuable at the end of the day. There's a lot of things they need to do that they could offload to a $5 an hour virtual assistant or, whomever, right? And oftentimes that's money very, very well spent, but only if they know what they're going to do with the time they're getting back.
Yeah, I would totally agree. Where can people find you? How can they get a hold of you if maybe you don't want them to get a hold of you because you're just going to get blown up with all these emails and phone calls?
No, it's all good. I mean, I'm pretty active on LinkedIn, and my last name is just Crowell. And then if people want to email me, I always give my email out, and there's always a couple people who email me, and hopefully I can give them something. But it's just jim@thesagehouse.com.
Okay. Well, we'll definitely put that in the show notes. And for everyone listening, as you know, I always recap everything in the show notes. There's things that you can go to. We'll put the Sage House website there, so you can click on that. But at the end of the day, you've heard it here first with Jim giving you sound advice on how to grow your business, where to get some money, and if you're thinking about franchising, you have an option there with Proof 3. Everyone, I really appreciate you listening today, and I'll see all of you on the flip side.
Thanks, Michael.
Thanks, Jim.